State pension in Ireland, how much you'll really get and when. The state pension is the cornerstone of most Irish retirements, but the rules around it have changed in recent years. The amounts have risen, and the catches are often hidden in plain sight. Today, I'll walk you through exactly what you'll get, when you'll get it, and what mistakes to avoid before you reach pension age. Let's start with the headline number. From January 2026, the maximum personal rate of the state pension contributory in Ireland is €299.30 per week. That works out at roughly €15,564 a year. The previous rate was €289.30 per week, so the increase was a flat €10 a week, announced in Budget 2026. Now that's the maximum. To get the maximum, you need to have made at least 2,080 full-rate pay-related social insurance contributions over your working life. That's the equivalent of 40 years of full contributions. If you have less than that, you get a reduced rate calculated under what's called the total contributions approach or the older yearly average method, whichever gives you the higher result. Pension age is the next thing to understand. The standard age to claim the state pension is 66. But since January 2024, people born after the 1st of January 1958 can choose to defer claiming their pension until any age between 66 and 70. If you defer, you get a higher weekly rate because the calculation gives you credit for waiting. For those born before the 1st of January 1958, the pension age stays at 66. If you have a dependent spouse or civil partner under 66, you can claim an additional payment for them, called an increase for a qualified adult. That's worth around €193.90 a week, depending on your circumstances. A couple receiving the full pension plus the qualified adult increase brings in roughly €25,600 a year between them. Now, here's where things get more complicated. If you reached pension age in 2025, only 90% of your rate is calculated using the old yearly average method, and 10% is calculated under the new total contributions approach. If you reach pension age in 2026, only 80% is calculated under the old method, and 20% under the new. This shift continues each year until 2034, by which point the calculation will be entirely under the total contributions approach. What this means in plain English is that the way your pension is calculated is gradually changing. For some people, this will work in their favor. For others, it will produce a smaller pension than they expected. It depends on the pattern of your contributions across your working life. If you have not made enough pay-related social insurance contributions to qualify for the state pension contributory, you may still be entitled to the state pension non-contributory. This is a means-tested payment, which means your savings and income are taken into account. The maximum rate from January 2026 is €288 a week for those aged 66 to 79 and €298 a week for those aged 80 and over. Now, let me give you some honest, practical advice. First, check your contribution record now, not when you're 65. You can do this through the My Welfare website. If there are gaps, sometimes you can fill them with voluntary contributions, but you need to know about the gaps in time to do something about them. Second, if you have worked abroad, particularly in the United Kingdom, the European Union, or any country with a social insurance agreement with Ireland, those contributions can be combined with your Irish ones to qualify for a pension. This is called combining contributions, and many people leave money on the table by not claiming it. Third, do not assume the state pension alone will fund a comfortable retirement. At €15,500 a year for a single person, the state pension is a foundation, not a full income. The cost of living for a single retiree in rural Ireland is typically between $20,000 and $25,000 a year for a modest lifestyle. That gap has to come from somewhere, whether that's a workplace pension, savings, or other income. Fourth, think hard about whether to defer claiming. Deferring gives you a higher rate, but you also forego the years of payments you skipped. The maths is different for everyone, and it depends on your other income, your health, your life expectancy, and your plans. A proper calculation or a chat with a financial advisor is worth the time before you decide. Fifth, do not forget the qualified adult payment. If your spouse or partner does not have a pension of their own, claiming the increase for a qualified adult can add nearly €10,000 a year to the household. Many people miss this because the application is separate. And sixth, remember that the state pension is taxable. If it's your only income, you'll likely pay no tax on it because it falls below the relevant thresholds. But if you have a workplace pension, rental income, or other earnings on top, you could find yourself in the tax net in retirement, and you need to plan for that. One more thing worth flagging. From January 2026, Ireland's new auto-enrolment pension scheme called My Future Fund has finally launched. If you're aged from 23 to 60, earning over €20,000 a year and not already in a workplace pension, you'll be automatically enrolled. This is a separate matter from the state pension, but it shapes the bigger picture of retirement income for everyone working in Ireland today. The state pension is a fine foundation, but only a foundation. Build on it carefully. Thanks for watching. Comment below with your own pension questions. Subscribe for more honest Irish money talk. Mind yourselves and check that contribution record.